Hi, I'm John Vance, founder, CEO, and Chief Investment Officer of Vance Wealth. Thank you for joining us today for our 2026 mid-year market update. I love doing these live events here because I've been doing them for over 15 years and I find that clients get a lot out of them. We get to share our insights of what's happening in the world, so thank you for joining us. One update that I want to provide is just a firm at a glance. Vance Wealth has really changed a lot over the last 20 years, let's say, and just want to give you a little bit of background of where we are today. Vance Wealth is a privately owned wealth management firm. We advise business owners and successful families to simplify complexity through collaboration and proactive tax strategy. To give you a little bit of insight of where we are, we manage just over $950 million for around 380 households. And we talk about household serves, that's just really families that we advise. Of those, 100 are business owners. We also work with 50 corporate retirement plans. We're happy to say that we are now up to 24 team members. And we have two primary offices, our headquarters in Santa Clarita, and we also have a new office in Costa Mesa. One of the things that I want to share with you is that Vance Wealth has 4 core business beliefs. And I wanted to share this at the beginning because today we're going to definitely focus and dig into the investment side of things, but I want to share these 4 core beliefs. Number 1, we believe wealth should be managed with a lifetime tax philosophy, not a one-year mindset. We believe execution is the ultimate differentiator. Ideas don't change outcomes, action does. Number 3, we believe clients deserve independent advice, institutional strength, and a relationship-driven firm that knows their name. Number 4, we believe wealth grows best through an all-weather portfolio with discipline, patience, and time, not the prediction of every market move. And like I mentioned, today's going to be really focused on that 4th item, really talking about how we view the world and how we build all-weather portfolios for our clients. Well, let's get some of the disclosures out of the way. So this is for educational purposes, and this is informational only. One of the things we're going to be going through a lot of economic and market data, and the key point to take out of this is that past performance is not indicative of future results, and it's just really important to know that all the content in here, the market data, forward-looking statements, this is for informational and educational purposes. So I hope you enjoy. All right, so today's roadmap, I wanted to lay this out in really 5 key areas. The state of the markets, so item number 1, the state of the markets. Number 2, really looking at volatility and the psychology of the markets, really addressing fear and headlines like what's happening out in the world. Number 3, reviewing the economic data. So what's the hard data that we're seeing, and really unpacking some complicated issues. I always like to describe this mid-year update as like drinking through a fire hose because we provide a lot of information, and that's where we'll get into some of the heavy lifting there on the economic data. Number 4, portfolio positioning. So how do we think through cash, fixed income, investing in stocks, and then how we're looking at alternative investments as well. And then number 5, really thinking through what we call planning close. So, what should clients do now? What should the key takeaways be of what we're going to cover today? So this chart just represents the last 6 months. And as I was putting this presentation together, one of the things that really highlighted the focus in the markets, that there's always what we call headline risk. There's always news of the day. That the reality is when we look back over the last 6 months, or frankly, the last 60 years, you can see that there's always things that are happening that drive the markets in positive ways or in negative ways. And so some of these that pop out this year, we've had a lot going on. The big highlight, obviously, from a market movement perspective, was that U.S. and Israeli launched a coordinated attack against Iran, and that led to initially a spike in oil prices. And so you can see over the last 6 months here what that did to the market. So right in the middle of this slide, you can see that in late March, the market dropped by about nearly 10. And then by early June, we got back to an all-time high. So this short 6-month period, it really is a good frame of reference for what happens with the markets all the time. There's always headlines of the day. And one of the key disciplines that we try to help our clients with is that we don't know what the headlines are going to be of tomorrow. We know there's going to be quite a few, but we don't want to make our investment decisions. We don't want to make our lifelong planning decisions based on these headlines, because it's not going to serve us long term. There's a lot of great, the power of compounding, there's a lot of great lessons to learn from what's happening in the markets. And so this is just really to show you, it's a tiny snapshot of the world and showing you tons of news headlines and tons of volatility, but it's really on us to help drown this out so that we don't make, say, ill-timed or poor decisions based on some of the headlines of the day. So let's just unpack some of the what we call the mid-year market scorecard. This is just to give you an update on how the markets are doing. I'm not going to read through all of this, but hopefully you can see on here the key things to focus on is the stock markets in the US and across the world had a really great start to the year. In many categories, up over double digits. So that's a great start to the year in spite of all of the turmoil that we've noticed that's happening on the news. The one thing that I do want to highlight on this is that core bonds, which is measured by the Bloomberg US Aggregate Index, shows a slight negative. And the main reason for that is when the conflict with Iran started, we started to see inflationary pressures back in the system. And with those inflationary pressures, there's some concern that the Fed might have to raise interest rates. And so that's why bonds have not had a good return as we look at the last 6 months. Right below that is cash. So cash, or the 3-month T-bill, has averaged or has made about 2% year to date. And so that's just an important thing to reflect back on. When we review performance with our client accounts, we'll notice that core bonds had a rough start to the year, but this just shows you the benefits of diversification. This is why we want to have money in equities. This is why we want to have money in bonds, because through market cycles, they will tend to balance out nicely. A couple things to highlight as well. Gold has had a little bit of a rough 6 months. We're down about 6%. And then Bitcoin, which is an alternative asset, is down about 27%. And then you can see there oil is up about 38%. And that's the price of crude. All right, we're going to dig into markets and psychology, climbing a wall of worry. So you can see the headline here. We said, learn to ride the wave. So the reality is we know investing can be emotional. And when we start thinking about, well, discipline is probably the most important habit we can have as an investor. It's certainly one of the most important habits, or maybe the most important habit we can have as a firm. And so when we look at this, the psychological wave, where are we today? And we can recognize on the far left-hand side, when we have periods of optimism, excitement, and euphoria, that's usually a point of maximum financial risk, because when everyone is optimistic, when everyone feels like things are going great, that usually means pricing is high. That means stocks are high. That means real estate could be high. And on the flip side, when we start going through a period of depression or panic or despondency, that's usually the point of maximum financial opportunity. And so I think depending on who you ask, they might have different answers of where they think we are today. I would argue that we're likely somewhere in the skepticism/hope. So on the far right-hand side, which tells me that our bull market that we've been in for over a decade has some more room to run, because we're not at this point of euphoria, certainly. And I would say that there's a lot of what I would call cautious optimism. So if I'm looking at the psychology component of this, I still think there's a ton of skepticism that's out there, and then I think there's quite a few, and we talk to our clients. There's quite a few of you that have this hopeful mentality as well, and so this tells us that while there are concerns on the horizon, that we're in a really good spot from a psychological perspective, because when you have those high levels again of euphoria, that just means that things are priced for perfection, and we don't think we're there right now. So that's a positive sign in our estimation. The next thing that we talk about, embracing volatility. I show this chart every time. I'm going to probably show it every market update going forward. This slide looks really noisy, but it's conceptually quite simple. So if you look at in the top left corner, it talks about the S&P 500. So this is representing returns of the S&P 500. And this goes back to 1980, so 46 years. And of those 46 years, we've had 35 that were positive. So about one of every 4 years, we have a down market. But the reality is, even though we have, again, 75% of the time, we have positive markets, there's an intra-year decline average of around 14%. And so what that means is that throughout the year, there's always volatility, even in a positive year. On the far right-hand side, if you can see it, it says YTD, year to date. So this just represents through the end of June that the markets are up nearly 10%, but you can see that minus 9% right below that. That just represents, it just goes back to the chart that we looked at earlier to show you that there was volatility throughout the year. Or sorry, there was a volatility during the year that we saw when oil prices spiked in the March timeframe. Another thing to call out here, because it's in our recent memory, is the volatility we saw during COVID. So if you look at the chart here, that would be represented by the 20 on the bottom, which is basically the year 2020. So during COVID, we had a max drawdown during that year of 34%. But if you look right above that, the market actually made 16%. So in spite of a really volatile and painful and a scary year for investors, the rates of return on the S&P 500 were still at 16%, which arguably would be a great year. So getting back to the title slide here, embracing volatility, that's one of the most important disciplines that we all have to have as investors, is knowing this has happened for the last 46 years, and frankly, I could show the same data going back 100 years, and it's likely going to continue for the next decade, century, because this is just something that is built into the fabric of the stock market. What this means for investors. Number one, volatility is normal. Abandoning a plan is not. Number two, diversifying is about preparing, not predicting. And number three, discipline matters more than timing. And those are really three key tenets when we look at managing our clients' money that we really want to live by. But a big part of why we're doing this education today is we need clients to also be comfortable with that approach, because when volatility occurs, if we're not well educated around the history of the markets, that oftentimes can lead to fear and to bad decisions. And that's what we really want to focus on here. And again, that's why I like doing these updates, to just continue to provide that information, to give comfort, knowing that this is normal and it's going to continue, even though we don't like it, to be honest, right? All right. So as we're going to now transfer into looking at some of the economic data. So when we started 2026, we really felt that this market was built on both fear and optimism. There's a healthy amount of both, basically, that we're seeing in the markets right now. So we're first going to unpack areas of concern, and then we're going to finish with reasons to be optimistic. So when we look at valuation, so one of the things, if you read the Wall Street Journal or just stay up on the press, on the press headlines, I should say, the market at a surface level appears to be at a high valuation. This chart basically goes back over the last 30 years. And so let me explain what's on here. So this is a valuation measure based on a price to earnings ratio. So that's known as a PE ratio. And you can see right across the middle, there's a dotted line that says the 30-year average. And so that is the average that we've seen of what a price to earnings ratio has been over the last 30 years. The dotted line above represents what's known as one standard deviation event above normal. And so not to get too technical into all this, but basically how you read this chart is that if you're above the average, then you're arguably in a more expensive market. And if you're below the average, you're in a cheaper market. So you can see where we are today in the top right. Now, and looking at that, the reality is we've been up at these high levels for the better part of the last 5 years. We had that dip when the correction hit in the markets in 2022, but we've been at these elevated levels for some time now. The reality is we think that there's a reason why it's okay that the market's trading at a higher level, and it's mainly because earnings are strong, and we're gonna reference that on a future slide as well. The next area of concern, or probably just uneasiness, is the labor market dynamics. We're getting daily, and even conversations I have with my kids about how AI is disrupting the job market, how people graduating from college can't find jobs. So, and the jury's still out to see the disruption that we're going to have, but the reality is the labor market is changing. And what we're looking at with these two charts, it just shows on the left-hand side, basically payroll gains. And if you look at over the last 3 years, payroll gains have been very muted, right? We're looking at really low numbers here compared to 21, 22. So that's obviously a troubling sign, because that, does that get worse? Does it improve? And the short answer is I don't think anyone truly knows the answer to that. The next chart on the right-hand side just basically lays out wage growth and unemployment. And if you notice those numbers, we're at actually historically good unemployment levels, but the wage growth has really fallen off. And I think that's where that's where there's a lot of concern is AI putting pressure on wage growth, because employers are saying, you know what, if I invest more heavily in technology, maybe I don't need as many people, or I can afford to pay them less. And so that's one of the things that is concerning, is that will this wage growth number change over time? And again, we do think there's going to be a lot of positive impacts on AI, but it's that uncertainty that's really hanging over all of our heads. And I think that's what is adding to that sense of fear and concern. Well, this chart, federal finances, I mean, I've been showing this for 20 years. We've had a budget problem. We haven't had a surplus since 1990. So this chart never seems to get prettier. It's definitely, I would say, one of our largest challenges as a nation and as an economy, is that we continue to spend more money than we bring in. So what we're looking at the left-hand side, I'm not going to go through all the weeds, but it basically just breaks out where all our total spending goes to, and what are the sources of funding. And then the areas I want to mainly focus on is on the right-hand side, that just shows basically our deficit and our interest payments and the cost to our economy. And then the bottom right just shows the net debt, meaning how much debt are we accumulating as a percentage of our economy. And you can see right now, in 2025, we're right around that 100% mark, and we're trended to go higher. So that's obviously something from an economic perspective we would like to see go the other way, but we have not seen that change, and we've been on this pace. If you look at the slope of that chart, basically since the mid-70s, we've seen this chart just basically head from the bottom left to the top right. And so this is probably, of all of the areas of concern, this is an area that has been a concern and is something that we will likely need to address. But I guess don't shoot the messenger. This is just what's happening in the world. And I think that we do need to deal with it, but it doesn't seem like there's a political appetite for that. Inflation component. So one of the things that we have noticed over the last several months is inflation has ticked back up, primarily driven by energy. So if you look at this chart, there's a lot of pretty colors here, and you can see the green represents energy. So the inflationary numbers that we've seen over since the beginning of the year, you can see those green lines start to really show up there, and that's just because of the spike we've seen in oil prices. We do think inflation is going to turn back down, but the Federal Reserve has a close eye on this, because they want to keep inflation under control. And so if we can get those energy prices to normalize, we've seen them come down a little bit, but every headline, I mean, it feels like every day something new is happening in the Middle East. And so until that gets resolved, we're likely going to see some higher inflationary pressures. But we do believe long-term that the spend on AI and the impact of AI on the workforce, the impact on AI on companies, is going to be highly deflationary. And so that's not a long-term concern of ours, but it's certainly a short-term issue that we need to be aware of. All right, the more fun stuff. We get to come in and have the conversation about the case for optimism. So what's out there that's working well? Well, at the end of the day, if you know anything about the history of the stock market, the reason why stocks go up is because profits go up. There's actually a extremely high correlation over a long period of time that earnings growth and the value of the stock market almost are move 1-to-1. Now, in any given year, there can be volatility, but from a long-term perspective, the stock market tends to track identically, like in line with earnings growth. And so the promise that we're seeing right now is that if you look at this chart, I know there's a lot of numbers here, but right in the middle, we're looking at earnings expectations for 26, 27, and 28. And you're seeing numbers well above norms. We're looking at earnings growth at 24% for this year, next year at 17, and the following year at 15. Like, those are historically really strong growth rates. And oftentimes you're not seeing this at this stage of the economic cycle. And so that's why we believe that multiples are high, or valuations are high in the market, because people who are investors like us are saying, well, if we're going to get good earnings growth, then these higher prices could be justified. And so that's what this data is showing us. And clearly it's because of the massive AI spend and the impact that it's having on the economy. But we think that's sustainable, and that we're in the early innings of this, not in the late stages. On the far right-hand side, you can see profit margins. So profit margins are at pretty unprecedented levels. And obviously this benefits the companies, because if they're making more profits, that is more earnings they report. And the more earnings they report, that's money that that those are the results that drive the stock market higher. Consumer finances. Well, this is one of the bright spots of probably the whole presentation, is that from a American consumer perspective, our balance sheet looks amazing. I showed you a few slides ago how bad the federal government looks, but our balance sheet looks amazing. What this shows you is that we have total assets when you look at homes and pensions and other financial assets around 200 trillion, and liabilities are around 20 trillion. So that means we're at a 10 to 1 ratio there, which is extremely healthy. When we start getting down into the minutia and really start looking at what's happening to the average consumer, right? Because a lot of this is heavily owned by the upper class. And so then what's happening to just the average consumer? And so on the right-hand side, you can see on the top, it says household debt service ratio. So right now we're at a fairly low percentage, which is a great sign at 11% in terms of debt payments as a percentage of someone's disposable income. The trend is, it is trending up. We feel like that's mainly driven by interest rates going up, right? Because the cost on credit cards, the cost on borrowing, to borrow to buy a car, all of those costs are elevating, and so that's why this percentage has gone up. But it's still historically very low, and that's a healthy number. The bottom right tells a little bit of a different story, because we are starting to see delinquency rates with auto loans and student loans. Not so much on mortgages, those definitely spiked up a little bit. But you can see when you look over the data down there, the data goes from 03 to 2025. We've been in this range here over the last 20 plus years. So we're still at a healthy, normal level. Consumer confidence. So this is, how much I love these noisy charts that have tons of data on them. This one's really simple. So we're gonna focus on a couple things here. So this measures consumer sentiment. So how are consumers feeling? In the top left corner, what this is summarizing, and I'm just going to read it to you. It says average subsequent 12-month returns. So if you look at this chart, it shows levels, let's say above the dotted line. So the average of consumer confidence is at 77. Above that line represents people have more optimism. They're more optimistic about the future. When you're below the line, that means you're more pessimistic. You can see where we are today. We have pessimism at a very low level, not quite the lowest of all time, but we're at an extremely low level, what got registered in June of 2026. But what's fascinating about this chart, it's a very good contrarian indicator, which means you're actually better off investing when confidence is low versus when it's high. It's very counterintuitive. And the data in the top left shows you the results of that. So there's been 10 sentiment peaks, which means high optimism. The average forward return on a go-forward basis for those has averaged around 4.8%. The 9 troughs, which means when pessimism was at a really high level, the average return on a go-forward basis was 24.1%. So what does that tell you? That tells you that when there's a lot of pessimism, that's a good time to invest. And when there's a ton of optimism, it's the exact opposite. And Warren Buffett has a fairly famous line is, be fearful when others are greedy and be greedy when others are fearful. And that's what this chart is really designed to show, and the data suggests that sentiment is spot on. All right, cash, fixed income, and interest rates. So one of the things I know we're all happy that our money in the bank, our in money market accounts, is paying more interest. And over the last several years, because we lived through about a decade where money in the bank was making zero. So things have improved there. There's a lot of data going on here, so I'm probably going to go through this pretty quickly, but this is what's known as a treasury yield curve, and it just represents looking back over the last, I have data on here from basically the last 20 years, and looking at the current environment. I recognize these colors are a little bit hard to pick up, but if you notice that deep purple line, it shows that short-term rates, and so as we read this from left to right, it shows it's measuring the yields at a 1-month level, 3-month level, 6-month level, 1 year, 2 year, 5 year, 7 year, goes all the way out to 30 years. And so what we're looking at today is that our rates are in the 4 to 5% range. And the reason why I'm showing this is if you look down at the bottom, this represents, there's like a green color as well as let's call it magenta, and that represents time around COVID. So the green represents the COVID emergency response when we cut interest rates, when we shut the economy down, and then it shows you where we are today. So we're at I guess we would say a favorable for if you're lending money to people because you're getting a higher interest rate. If you're borrowing money, you got to pay more. But the reality is we're in a healthy environment. The reason why I stacked all these together, it shows you that interest rates are at a normal level, things that we saw back in 2006 before the financial crisis. So we're in a very normal spot for the Treasury yield curve. And I think it's going to stay this way for a while. There was a lot of chatter over the last several years that rates were going to come down quite a bit. And we feel like this is probably the normalcy that we're going to settle into. And there's obviously going to be some volatility here, but we feel like that's the normalcy we're going to settle into on the treasuries. All right, this gives you, really looking at the Fed and interest rates. The chart goes back to 1993, and it just represents the volatility of the Fed funds rate. So the Federal Reserve, the rate that they set, which drives interest rate policy. And a couple things to highlight here, if you look back in the 90s, we had rates were in the 5s and 6s. Then we had the dot-com bubble burst, rates plummeted post September 11th as well, and they bottomed out around 1%. Then we saw the economic recovery, rates went back to 5. Then we saw them plummet at post global financial crisis down to 0. We essentially stayed at 0 for a pretty healthy period of time. And then right before, we started to have economic strengths, and the market started to ratchet back up. Then COVID hit, went back to 0, and then you can see the massive jump up that we saw from COVID recovery until where we were a few years ago, up to 5%. And now the direction is coming back down. So long and short of this, I wanted to give you a little bit of historical precedent. The long and short of this data just basically shows us that the Federal Reserve wants to have their rates set between this 3 to 4% range, and we're essentially in that range right now. Market expectations, which is represented by green, have trended higher here over the last few months, and it's primarily driven because of the rising of energy prices, which is putting some inflationary pressures on the system right now. Okay, now we're going to jump into the stock market update. So, man, I got a lot of fun slides here today, don't I? With lots of colors and a lot going on here. So this is one of my most favorite slides I'd like to share with clients, but a lot of my team members, because I really have done a ton of research on the economic cycles and understanding markets going back, for the last 50 years, let's call it. So it's fun looking back at the dynamics of what the stock market looked like. And so what we're looking at right now is, on the right-hand side, these two big bar charts that represent 2025 and July of 2026. This basically shows us what companies make up the top 10 holdings of the S&P. And if you look on the right-hand side, a lot of familiar names from NVIDIA, Apple, Alphabet, Microsoft, Amazon, Broadcom, Micron, Meta, Tesla, and Eli Lilly, right? Those are the dominant companies of today. And then on the left-hand side, it's always fun to look back at some of these names like DuPont, Kodak, AT&T, GE, a lot of these old school names. And the reason why I'm showing you this is that we are believers of broad diversification. And broad diversification doesn't mean we just want to own the top companies of the day. We want to own the whole broad market because we don't know who the winners are going to be in the future. So it's really important that when we build a diversified portfolio, that we don't fall in love with the names that are at the top today. We're going to own them, but it's really important to make sure we have broad diversification, because this list in 10 years is going to look different. There's going to be new leaders. There's going to be companies that might not even exist today. And you can look at some of these names that did not exist on this. They weren't on this list 10 years ago. Certainly weren't on this list 20 years ago. I think the only carryover on that list going back to 2005 is, I think it's Microsoft, if I'm seeing that right. So it's just pretty remarkable to see that, because I think when we live when we live in the present, we can't imagine a world where these are not the dominant companies. But the reality is, we know the future will change. And again, this just helps me to highlight the fact that we want to be broadly diversified. We want to own the smaller companies that are up and coming, because that will take advantage of the growth as they become the market leaders. So one of the things that's happened this year, the Mag 7s are, the Mag 7 companies are extremely popular. That's NVIDIA, Microsoft, Apple, Alphabet. Amazon, Meta, and Tesla. In 2026, they've been left behind. So if you look on the far left-hand side, you'll see what the returns of these, based on the calendar years 2023, 2024, and 2025. The Mag 7 had delivered extremely strong returns over the prior 3 years. Year to date, through the end of June, it's slightly negative, down 2%. And the rest of the other 493 companies on the S&P are actually positive, up 16%. We do think we're going to start seeing the market spread out, and we're going to start seeing returns more broadly applied to the whole market rather than concentrated in the top 7. And we do believe that this trend will continue for the next, let's say, 5 to 7 years. We think the trend is going to start to shift away from, again, more broad diversification. So I know the Mag 7 is popular. Those are the largest holdings in most people's portfolios, and they should be, but it's also important to maintain that diversification. The other thing that I want to highlight here, without going through all the names, is that we are seeing a massive market concentration across the world. So on the left-hand side, it shows that the U.S., that the biggest 10 companies make up 38% of the market, that has never happened here in the U.S. If we look at emerging markets, that represents 41%. We look at the the Eurozone, that's at 30%. And then if we look at Japan, it's around 30%. So we have these massive equity concentration that has occurred over the last, obviously the stock market performance over the last 10, 15 years has led to this. But we do think, again, this is going to start to broaden out as we go into this continued bull market with the overall world stock market. So it's always fun to look at some of the names there. So hopefully and we can make this slide deck available as well if you're just curious to see and dig a little bit deeper in. But I don't need to make an expert on all these companies around the world. All right, well, we're going to get into artificial intelligence. I'm pretty sure this part of my presentation will be a stable, meaning we'll have it in here all the time because the AI conversation is not going away, and we think that's a good thing. So the reality is, when you think about the overall markets, AI companies make up a massive percentage of the world stock market, and we believe this percentage will continue to go higher as AI starts getting adopted on a more grand scale. I have some slides in here to go through that, so I can show you what the adoption rate look like, but you can see just the high percentages that we see in the US markets as well in the overseas market. One conversation that continues to come up, I see this in the media everywhere, is that what's happening in AI is basically, it's going to be a repeat of the dot-com bubble. And that might be true at some point. I'm not ruling that out, but where we are today, we're far from that. The difference, and I lived through both of these being an advisor, the dot-com bubble, we saw a ton of companies that didn't make any money, and the stock market rallied up. And what we're looking at here on this chart just basically shows how well the technology stocks did during that time. And during the 90s bubble, you can see that basket of technology stocks was up over 1,000%. What we're seeing during the AI boom, right now we're at about half of those returns. So that statement might be true. I just think we're very early. And at the end of the day, we know that markets tend to go through these periods where we get markets overvalued, then they correct, and that's part of the volatility that we understand. But we do believe that this is way overdone, and that it's a little bit more of that fear. If you remember, we talked earlier about the psychology part of it, and I think that's that healthy level of skepticism that is making its way into the psychology of investors. And again, we think that this is going to be a headline that you will continue to see, but we're not concerned about it at this time. The chart we're looking at here is just talking about the hyperscalers, right? These are the companies, Alphabet, Amazon, Meta, Microsoft, and this is just representing how much money they're spending. This chart kind of blows my mind because if you look on the left-hand side, it shows how much they're spending in billions of dollars. Just look back in, let's say, 2020. They spent on basically infrastructure spend about $97 billion. They're estimated this year at $750 billion. So the amount of spend that's going into the system is massive. Now, on the right-hand side, it's showing that is actually causing a negative on free cash flow because these companies are trying to get ahead of investing, and they need to be the first to market and really win this race. it's causing them to spend so much money, even though their operating cash flow is going up because of their capital expenditure, their free cash flow is coming down. And that's kind of that's some of the pessimistic view of where people have the concern, and they're trying to tie this to the dot-com bubble, is because they're looking at some of this data and there is some concerns up there. And again, these things will play out, but that's why we truly believe in being diversified, building an all-weather portfolio, so that if some of these forecasts come true and they go into negative cash flow, that investors are prepared by being diversified. As we dig into AI implementation, I'm going to mainly focus on the right-hand side of this. So the headline says, businesses using AI in any business function. So how are businesses using AI, again, in any business function? And then it basically just shows if you're looking at information, professional, education services, finance and insurance. And so you can see the big adopters, and then you can see that the average right now is only that 21% of companies report that they're using AI for any business function. When we start looking at this, in, let's say, even a year from now when I report back, that number, I don't know if I can say confidently that it's going to double, but these numbers are going to keep going up. And it's because the impact of AI is having such a downstream benefit for businesses. We know it here, like we're able to do more work more efficiently, and the product is even better. And that's happening at our small company here at Vance Wealth with 25 people. And just think about all of the companies that are benefiting from this. And so that's why we do think that the tailwind of AI is going to continue to broaden out and strengthen the economy, because there's a bunch of industries that need the help and they need to be reinvented, and AI is really driving that innovation. All right, we're going to talk a little bit about international markets. We'll be brief on this. I'm going to talk a little bit about, again, the importance of broad diversification. So the S&P 500 is 500 companies. When we look at the MSCI All Cap World Index, it's 2,400 companies. As we start to expand and we look at one of our preferred partners that we use as dimensional funds, their market ETFs, it represents 12,000 companies. And so we do believe that having this broad market exposure is extremely important, and it's because we believe that the AI tailwind is going to lift all boats. And so the companies that maybe have been left out from some of the performance over the last 3 to 5 years are going to really benefit from the AI tailwind, and that's why we want to make sure we have broad exposure and not just be focused on, let's say, the S&P 500 or the Mag 7. And this was also interesting looking at, it just shows you how powerful the US markets are. So this represents the total weights of the Magnificent Seven. It represents around 20%. And then you can look at the top 7 countries, not companies. These are countries, represents around 21% of the total weights of the world. And then on the right-hand side, it shows the global earnings. So these should be on par, meaning if the US markets represent about 20% of the total weight, then earnings should be about 20%. So you can see this is where we believe international is you want to have diversification there, is because we believe international, the earnings are quite strong in a lot of these countries, but the value of the companies have not kept pace. And so again, this just comes back to maintaining that broad diversification. But I found this chart to be just interesting, just showing you just the sheer size and power of our great companies here in the US relative to the rest of the world. All right, we're going to have a little bit of a rapid fire here as we go through alternatives. So what we put into alternatives is basically anything that is not cash, fixed income, and stocks. So what's the other bucket? Well, we look at real estate, gold, oil, crypto. And we just want to highlight what we're seeing in those markets right now, and just to shed some light on performance, observations, and just some expectations on a go-forward basis. So basically this chart shows, goes back to 1960, that you see home prices rising up, from 20,000 in the 60s up to over 500,000 today. The purpose of me showing this chart is a little bit more focusing on the near term. So if you look at the chart where we've gone from about 2020 to 2025, we're seeing that home prices after that COVID bump have really stabilized. And we do think that that is a normal part of the housing market. The reason why they've stabilized is, number one, is we had the big bounce, which was not sustainable, and then interest rates went up, which made affordability come down. And so we believe this leveling off of the housing market was necessary, and it's actually healthy to regain our footing. And that's what this chart just basically is showing us in terms of just the average sale price has really has tapered off. This next chart we're looking at is just looking at the National Home Price Index. And you can see prices have more than tripled since 2000. And so it just reflects a little bit of the same data, but it shows us on, I believe this is a nominal price chart, I believe. So it just shows us that we're seeing some of the numbers on the home sale data, and that it is leveling off. We're not seeing these massive run-ups that we've seen in prior decades, which again, we think this is a healthy part of the economic recovery. This is the real version of this. And so what we are seeing with home prices, this is representing real home prices adjusted for inflation, that shows the true purchasing power of housing over time. And we're back to some of these 2006, 2007 levels. We're actually a little bit over the peak, but we are seeing the housing market still just level off. A lot of I think individuals were concerned that the housing market was going to crash. Our opinion was we just thought it was going to go sideways for potentially 3 or 4 years. That's what's happening today. When are we going to start taking off? Interest rates probably are going to have to start to come down a little bit in order for the housing market to really take off again. Otherwise, we feel like going sideways for at least the next couple of years is probably realistic. All right, so this represents a chart that goes through and identifies global private real estate returns, which is not residential, right? This would look at private real estate returns, commercial properties primarily. And what we're looking at here, what I really want to highlight is that when you think about owning real estate, there's 2 components of the return, right? You have income, right? The cash flow that's being generated, and then you have capital appreciation, which is the growth of the value of the asset, right? So if you bought something for $1 million and it's now worth 1.1, that's the capital appreciation component. So this chart goes back to 2009, and you can see during the global financial crisis, you can see all that orange on the bottom left. Capital appreciation, it was actually depreciation, right? The value of these assets went down. Then we went through the post-recovery where income was quite strong, but then appreciation was noticeable for that 10-year period. And then you can notice the COVID spike, which was in 21, 22, where capital appreciation on private real estate went through the roof. And then once interest rates went up, now you can see it's been a tough environment for real estate investors over these last 4 years. We do believe this is going to start to change or start to turn. We're starting to add more of this into our allocation strategy because we're confident that we're through the lull in the cycle, and that we're going to start seeing some positive gains on the backside of this data. But this just, again, is designed to represent what's been going on over the last 16 years, and we think the trend is now in our clients' favor. And so we've been looking at adding. We really started adding into this starting this year in January. Because we've been avoiding it on purpose because we just didn't think the fundamentals were very strong, which again, we think that has changed now. All right, so infrastructure. So one of the things that I think we all recognize is that we have, especially here in the US, we have massively underinvested in infrastructure. Water investments, road investments, power, transit, airports. I mean, we see that a lot of our cities have aged and we're not reinvesting and rebuilding them. This is not something that is unique to the US. So on the left-hand side, this represents what's happening in the US. It's identifying the planned funding, but then also the additional funding needs that have been estimated going out through 2033. On the right-hand side, it also shows the infrastructure investments that's needed across the world. And if you look, US is a substantial portion of that, but Asia is as well. And so this is, we believe, is a tailwind for the markets, real estate and stocks, because there's going to be a massive amount of capital spent to continue to improve our infrastructure, getting it ready for this new digital age. I know I can't say new really because we've been living in this for quite some time, but we still haven't really invested to get our infrastructure caught up with the times, and that's going to take a massive investment. And again, that's another reason why we're bullish on where things are heading. Gold and silver. So we have a lot of conversations with clients around gold and silver. I think when pessimism goes up, gold seems like a safe haven. And traditionally, it can be a safe haven. The reason why I want to show this chart is that everybody wants to own gold when prices are high, but this chart shows, and if you look at the bottom left, gold had a bear market from 1980 to 1999. So that was almost 20 years. and the gold prices went down 62% over 20 years. So that is what we call max drawdown. The S&P has some tough periods, but they tend to be short. So if you look at the max drawdown on the S&P, it was down roughly 51%, but that occurred over 16 months, a little bit over a year. What this chart is designed to show you, the top left is the recent returns. What's going on this year? It's a short time frame. The S&P is doing well. Gold and silver have corrected. On the right-hand side, though, it shows you the growth of wealth going back to 1970. So looking at a 55-plus year period and showing how much stronger being invested in the markets are than gold. And so gold and silver will play a part of the portfolio because there are gold and silver companies, right? And that's part of the overall index. But we tend not to want to be overweighted in these because historically these are not great long-term compounding assets. They have periods of time where they can do well, but we believe that the S&P, or not the S&P, the stock market over time is a better place to be long-term, but gold and silver can provide some diversification benefits. But this is just designed to show you, give you a little bit of just updates on what's happening or what has happened in these markets just to provide some context. Lower future oil prices. I have a question mark on this. So right now, crude oil is projected to drop in price. And so on the right-hand side, this basically just represents what the futures market is estimating is going to happen with the oil prices going out 27, 28, and 29. And you can see all of these numbers are starting to converge in that like $60 to $70 a barrel. And I think at those levels, very healthy for our economy. So that's a positive sign. But right now we've seen the spike up, obviously, with crude prices here as of late that we've already mentioned. One thing that I do want to highlight on this chart, the oil in the U.S. economy, is this top right chart basically shows U.S. net imports of petroleum and related products. And this is, I think, a very happy chart to show us is that we are no longer net importers. And if you look in the bottom right, you can see it's in the blue, which means it's below that line. During the 70s, over the last, forever, our nation's history, we've been a net importer of energy. And so now we have much more energy independence, which is really critical. So we're very pleased to see that because that's a positive sign for us on a go-forward basis, is to make sure that we're more energy independent and not dependent on other nations. The bottom right-hand side is, I think, where the average consumer is feeling a lot of pain. What this basically represents is that consumer expenditures on energy, if you're in the bottom 20% of income earners, it represents about 17% of your overall spend between gasoline, electricity, and natural gas. And if you're in the top 20%, it's only 2.7%. So I think this is why there's a feeling out there that the economy is not working for all, because the rise in energy prices is dramatically impacting the bottom 20 earners and even the next tier as well. But again, from an overall economic perspective, we're in a very healthy environment where we are with oil prices currently. Portfolio management. So we're going to get into just some education around how we think through designing portfolios, how we think about risk. So let's just jump in. So we have these conversations all the time, especially when we onboard new clients, about risk. And I think most people define risk as market risk. And we talk about, so what I have up on the screen here talks about on the left-hand side market risk, and on the right-hand side purchasing power risk. Market risk I would define as volatility. The fact that on a day-to-day basis, they're going to move up and down, right? If you go in and look at what's going on in the markets every day, they're going to either up or down, and there's volatility every day. It also feels visible and immediate, right? You know it because you can actually pull up your app and see how your money is doing. And when you look at the volatility, these short-term declines are uncomfortable. When we look at the right-hand side and talk about purchasing power risk, that represents primarily inflation, and that over time, inflation gradually reduces what your money can buy. And I know in many of the conversations, I think in general, people place a higher focus on volatility or market risk. We tend to put a much higher focus on the purchasing power risk, inflationary risk. And that's what this section is really designed to discuss, is that both are important, but you can't just isolate one without the other. It's really important to be managing both. And when we think about portfolio management, we recognize that you want to stabilize market risk with diversification. You also want to have equity or stock exposure long term to deal with inflationary pressures. So let's just look back over the last 30 years. So when you think about, I've highlighted 5 key areas here. So we're going to look at cost of living, we're going to look at the 10-year treasury, we're going to look at the 3-month T-bill, which is basically cash. We're going to talk about the S&P 500 dividends, so the cash flow that's being generated by the S&P, and then the S&P 500 index level, meaning how much did it go up. So in looking at this, the cost of living going back 30 years has more than doubled. It's about 2.1 times. The 10-year U.S. Treasury, you used to be able to earn 6.3% on that. It's now 4.3. So if you were living off 10-year Treasury income, you had a decrease in your cash flow. On a 3-month T-bill, you can see it went from 5% down to 4.1. So that's a decrease in cash flow. On the S&P 500 dividends, your income went up just over 5x. So your cash flow went up 5x. And so let me just pause there for a second. So if you think about it, cost of living went up 2 times. Your treasury income in both cases, or your T-bill income, went down, and dividend income off the stock market went up over 5x. Additionally, the last box here talks about the S&P 500 level. Not only did the dividend go up 5x, the price or the value of that went up 9x. So this is just here to demonstrate the power of equities, the power of these being invested. And so we always have to keep an eye on the safety component and the growth component. We can't do it in isolation. It's critically important that we think through this. And so this is how, when we build all-weather portfolios, we're thinking about how do we balance stability and long-term growth. And this is how we build our portfolios. So we always have to put a focus on near-term stability. How do we lower the volatility for our investors? How do we make sure portfolios are working? And we can do that through money market, through T-bills, through high-quality bonds. They're designed to provide stability in the account. How much you need in there is just depending on where you are in life. If you're retired, you probably need a little bit more. If you're actively working and you rely on your paycheck, you probably need a little bit less, but that's the reality of balancing this. Then when we look at long-term purchasing power, the reality is we don't know how long we're going to live, but we do know that health advances are causing us to live longer and longer. For years I've had conversations with new clients that come in at 65 and they're ready to retire, and we start talking about long-term investing, and I said, "What do you mean long-term investing? I'm ready to retire. I don't have a long time horizon." Then we try to refocus that and say, "Well, what do you think the probabilities of you living to maybe 85 or 90 are?" And they'll oftentimes say, "Well, I don't want to live that long." But the reality is, like, their parents lived that long, and so they know that they have to prepare for the long term. And so when we start thinking through someone who's 65 years old, the reality is some of the money you're going to need at 65 and 70, it's designed for stability. But what about that money you're going to spend when you're 85? What about that money you're going to spend at 90? I have a concern, and this is a big part of why we're such big believers of long-term investing, is I think we're going to have a lot of our clients that are going to live well into their hundreds. And if we're too focused on short-term stability, we're not going to be building that portfolio and building that growth for a retirement that could last much longer than 30 years. So again, that's why the planning process is so important. And when we look at, really wrapping this section up, a meaningful stock allocation can be uncomfortable at times, but it has historically helped protect purchasing power, especially in retirement. And those are the things we have to balance, and that's that's part of that building an all-weather portfolio. This data here just shows us, just basically puts this into a visual, the power of compounding. So large cap stocks going over the last 30 years, $10,000 invested in that grew to $90,000. The bottom line represents cash, and that's in purple. 10,000 inflation adjusted grew to 9,798. So think about that impact, is that if you want to have your income continuing to grow over time, we want to be invested in assets that are going to grow over time and not in assets that are going to be stable or lose slightly to inflation. This chart really highlights the whole idea around diversification matters. So one of the hardest things with being an investor is the reality day to day, and you can see this on this chart, 1 day probability of positive returns is about 53%. So about half the time it's up, half the time it's down. When we started expanding that out and saying, well, what about 1 year? Well, now all of a sudden, 1 year, we know the probability goes up to north of 80%. When we go out to 10 years, on an all stock portfolio, it's around 93, but on a 60-40 portfolio, which would be 60 in stocks, 40 in bonds, it's 100% frequency of positive returns across these timeframes. And so conceptually, we know the more time we have to plan, the more in tune we have with expected returns. Let me say this another way. When we have a short-term time frame, I couldn't tell you if the markets are going to go up 10% in the next 6 months or down 10%. That short of a window is just unclear. Nobody has a crystal ball. But because of the power of compounding, because of the power of our economic system, companies innovate, companies continue to build great products, and their earnings and profits go up over time. So the longer we go out with 5 years and 10 years, the probability of having positive return goes up, and we think that trend will continue. Okay, so what should our clients know? So the goal is not to react to every headline. The goal is to make sure your plan is still aligned. So I break this up into really 5 key areas. Review your cash. So make sure you have emergency reviews, what's your known spending. That's really important. Reposition fixed income. We see too many people come in that have way too much in cash because cash is attractive finally, but we feel like we should be using bonds more intentionally, because if interest rates come down, we're going to want to own things other than cash, because the concern there is rates come down, your yields on your cash will drop. Check your concentration. The markets have done, especially technology, has done so well over the last 10 to 15 years. We just want to make sure that AI companies, mega cap companies, your employer stock, just aren't, you don't have over concentration. So that diversification approach is really, really important. Rebalance thoughtfully. Use discipline, not emotion, to bring portfolios back to target. And when we say thoughtfully, it's like, yeah, we have to be mindful around taxes. It's not always an easy decision, but we want to use discipline when driving the rebalancing conversation. And then the 5th item here is just update the plan. Looking at, evaluating your spending needs, analyze your tax exposures, broaden your diversification, and maximize charitable giving opportunities. And so those are really the summary of our talk today, is those 5 areas. And so if you're a client of ours, we're doing this actively for you. We've likely already had your annual review meeting. We're getting ready for year-end meetings as we head into the fall. And so if you have concerns about this, feel free to reach out to your advisor. And if you're on here as a guest and you're not a client, these are great things to contact us about, so that we can potentially add some value to your situation. What we're focused on at Vance Wealth. So number 1, helping investors stay disciplined through uncertainty. Number 2, ensuring portfolios remain diversified and aligned with long-term goals. Number 3, making thoughtful adjustments when needed without reacting emotionally. In markets like these, our role is simple. Provide clear, informed guidance so investors can make confident decisions. So if you want to continue this conversation, and again, if this applies to your own situation, we're happy to talk. You can scan this QR code or visit vancewealth.com/book an appointment, and you can have an initial conversation with one of our advisors. They are complimentary. One of the things that I'm so proud of is building a firm that is growing, is that allows us to take care of and serve more clients. And so take us up on that offer. We're happy to do that analysis for you and see if we can make an impact on your life. Thank you very much.